Hello and welcome to YouTube Now. You're watching IPO Central and my guest today is from Park Medi World. It's a hospital chain running out of northern India. The company's IPO is opening on December 10th, closes on December 12th. A price between 154 to 162. It's a total IPO size of 920 crores, which includes a fresh issue of 770 crores. And joining me today is Mr. Ankit Gupta, who is the promoter and MD of the company, and Rajesh Sharma, who is the Chief Financial Officer of the company. Gentlemen, thank you very much for joining us today on ET Now. Ankit, let me start with you. Give us a sense of your operations. You are largely based out of northern India, but how big is it?
We are the second largest chain of hospital in North India with 3,250 beds. We have 14 hospitals in 5 states.
Rajesh, if you can give us a sense of the 770 crores that you are raising in primary, where is it going to be used for?
Our proposed end usage is 380 CR is outlined for repayment of debt, 88 CR for capex, largely for equipment, and a small portion for our organic facility that we are developing in Rohtak. 250 CR for general corporate purposes. We intend to utilize this capital mostly for pursuing acquisitions going forward, and 50 CR is outlined for issue expenses. Everything totals 770 CR.
Okay. Also, if you can, take us through, Ankit, what has been your growth strategy for your chain over the last 2 to 3 years? How is your journey been, and going forward, how do you plan to expand your operations?
So, a journey of Park started around 40 years back when my father, Dr. Ajit Gupta, after finishing his medical graduation from Safdarjung Hospital, started his private clinic practice. We used to see 300 to 400 patients a day at a very low cost, which gained him huge popularity, and he was called as healthcare messiah of that region. Idea came in his mind that time that he should have a comprehensive healthcare facility to treat masses at affordable cost. I, Dr. Ankit Gupta, when I finished my medical graduation from Bharatiya Vidyapith Pune in 2005, I shared the same vision of my father to create the world-class, quality, affordable healthcare structure for masses. With that vision, first hospital it started in West Delhi in 2005 by 200 beds. From now, we have become the second largest in North India with 14 hospitals, 3,250 bed capacity, and spread across 5 states. So our success story is a mixture of my successful greenfield expansions and also my successful brownfield acquisitions. I can say now that we are industry leaders in converging sick units into profitable ventures in record time. We focus on quality. We are all NABH accredited hospitals. We are given more than 60 seats in postgraduate teaching program by Government of India. We have a strong corporate governance in our hospital, where each and every hospital is individually managed by a CEO. He or she is independent decision-taking body. We also invest in upgradation of medical technologies, latest innovations like AI. We invested huge in robotics technologies. We are doing robotic joint replacements, robotic interventions, etc. Our growth strategy is based on 4 pillars, strong 4 pillars. First is we'll have growth by increasing the number of beds. Number 2, we'll have growth by increasing the occupancy in the hospitals. Number 3, we'll have growth by doing a product mix where the occupancy have reached 75 to 80%. But we'll keep in mind that our ARPOB doesn't go beyond 35,000. Fourth, our brownfield acquisition will lead us to successful growth.
You've been growing through inorganic route a lot. Nearly 50% of your beds have come through that route, if I'm not wrong, because you've acquired nearly 8 hospitals, accounting for nearly 1,650 beds. How do you look at inorganic growth in the northern India where you are operating, and do you plan to come to other regions as well, geographies as well, like a west or a south?
Yeah, I like to say that it is just the tip of iceberg. We are present in just 14 districts in North India. North India itself has more than 170 districts. So we need to grow very aggressively to reach all the affordable cities and towns. We see a huge headroom for expansion. As I already stated earlier, that our total addressable market is around 90% population in India, which falls under the class of affordability.
You are also acquiring hospitals through the NCLT process as well. How is this market doing in the northern India? What is the kind of growth that you see there in terms of occupancy and in terms of pricing which is there?
You see, your question I think is in two parts. First of all, I'll talk about part A. Acquisitions compress go-to market. So intuitively, this is a very compelling way of growing fast. We believe companies that have proven capability of acquiring important assets in a compressed time frame, extracting good performance out of them will have competitive advantage going forward. So we believe this prowess that we have exhibited will stand us in good stead. We have also, yes, you are right, acquired a hospital under the provisions of IBC recently in the northern part of Delhi in a location called Narela. Fantastic location. We are very excited about this asset. We shall be completing this acquisition shortly. We received court consent approval to this acquisition on the 7th of October. This is a 200-bed facility which potentially could be increased to 275-bed capacity. So this has happened. We believe that we have got this asset at a compelling valuation. We will be happy to look at similar opportunities going forward. In addition to this, if you can just restate, you had a part 2 question when you framed this to me.
India, belt growing in with respect to occupancy or increase in beds for hospitals.
We have, I'm happy to share with you that we have been a very consistent performer. You see, we are positioned in the bottom and middle of the pyramid largely. So our patient intake is substantial. We cover vast swaths of population. As per latest numbers, since 2025, when we had an aggregate occupancy of 62%, we have raised this further as of H1 FY26 to 68%. We believe that our occupancy following current trending will be crossing 75% in next 12 to 18 months time.
What is the kind of expansion plan that you have, because you have some hospitals which are under construction, and when are these new beds going to be operationalized from your end, Mr. Gupta?
Yeah, we'd like to sum up that. Yeah, we are currently 3,250 bed capacity. We'll be adding 2,000 beds. Will be 5,250 beds from the next 2 years, and after that will be next 5 years. I see a total bed strength of 10,000 beds.
And how will this investment be made? Is it going to be entirely through internal accruals and IPO proceeds, or you going to take debt as well, because you're repaying some of the debt as well, if I'm not wrong?
It will be a mix of debt, accruals, and equity.
The total capex we had provisioned for these 6 assets which will be commissioning in the next 24 months time was estimated at 458 CR, of which 130 CR we have already incurred. A large part of this expansion is going to be funded by internal accruals only. A small portion of IPO proceeds will go to part fund the expansion of Rohtak facility that will be commissioning in FY28, but rest of it is going to be funded solely by internal accruals.
What is the kind of total debt that you have before this IPO, and post IPO, how much of that debt is going to come down?
Our H1 FY26 outstanding debt was 425 CR, but I have to also apprise you here that at the same time we had immediate liquidity in the form of totally unencumbered FDs totaling 305 CR. So if you should factor in this number, then our net debt outstanding will add up to only 120 CR. In the IPO, we are proposing to retire 380 CR of debt, which will make us grossly under leveraged company. Our net gearing effectively will be 0.
And and what is the kind of cash flows that you generate on an annual basis that can support future growth as well?
Our free cash flow generation is in the range of 250 to 260 CR. While stating this, I am leading on FY25 numbers.
Okay, Mr. Gupta, you are in a region and you're catering to a segment which is mid and lower segment. How is the average revenue per bed operational bed moving over the last 3 to 5 years, and are customers in this region willing to pay higher prices compared to what you see in some big cities or metros?
Since 21 years of work, since 21 year of working, we have solidified our strategies and policies. We are keeping ARPOB at 28,000 on average, which is on a real time affordable for the masses.
And is there a elasticity here, in the sense that if you are able to raise the prices, you will be able to you'll be able to sustain the kind of occupancy rate in these beds?
Yeah, as I stated before, that we have point number 3 of my growth strategy, where we'll have growth by increasing by ARPOB up to extent of 35,000 only in hospitals where I have reached occupancy of 75 to 80%. I will do a product mix, and a product mix will lead to an average increase in ARPOB to 34 to 35% only.
And how is this product mix going to change from where it is now to over a period of next 3 to 5 years?
Product mix is going to change as we go along. We have, if I should broadly classify our running hospitals into 2 categories, broadly we have hospitals which are recent acquisitions at a certain point of their life curve with an occupancy of 50-55% or slightly lower. In these hospitals, our growth, as we stated earlier, will mostly come through increase in occupancy rates. At the same time, we have hospitals which have strikingly realized very high occupancy levels. We have some of these hospitals in the NCR location where occupancy is as high as 85%. We have a very strong, purposeful, conscious intent here to equip these hospitals with a very, very advanced state-of-the-art medical equipment and specialists which will enable these hospitals to undertake complex medical procedures, advanced medical procedures. So there is going to be a shift in a mix of services we will offer across hospitals accordingly. These hospitals will significantly be positioned as a super specialty, very, very advanced hospital care entering hospitals, and in other hospitals where, as I said, we intend to grow through occupancy rate increase, we will have the mix more or less in alignment with what it is, because these hospitals meet the requirement of the micro markets they are present in fairly accurately.
Also, if you can give us an understanding, Mr. Sharma, with respect to how much of the patients who are coming in are direct, how much are linked, direct in the sense self-paying, and how much is through insurance, and how much through other third party?
A very interesting question. Just as a pre-thought to this question, though, I'd like to state that our business model is not created keeping in mind what the payment mechanism associated with the patient is going to be like. It is regardless of that. Now I'll come to specifically answer your question. If you look at the business mix, we consciously built a business which is in very, very close alignment with the real macro situation in the country. The matter of fact remains that 90% of our population belongs to what we call as bottom and middle of the pyramid. This section of population also incidentally tends to be covered by some of the other government schemes, which is just government insurance. So in our revenue mix, when you look at, we have 84% of the revenue that comes from government schemes, which is nothing, just a patient profile, which is 84% belonging to middle and bottom of the pyramid, and 16% of revenue belongs to cash TPA segment. TPA is nothing but private insurance. So this is the mix we have.
So if that is the thing, what is the kind of working capital requirement or working capital days that you have? Because getting payment from the government takes normally some time. So how do you manage that working capital days?
Following things, first of all, we realize our payment from government schemes within a span of 4.5 months, and this has unfailingly been within this time frame. Our experience is that these payments are highly structured. They come to us through a transparent, faceless mechanism and are very, very time bound. We are comfortable in this band, which is evident from the fact that We have continued over the years to be financially very strong in terms of our cash flow generation. We would like to think that technically this working capital we provisioned in the past historically, it is done and dusted. It does not affect our day-to-day operations at this point of time. We generate our cash flows on a rolling basis. As I shared a few moments back, last year FY25, in 12 months, we collected 93% of FY25 P&L top line revenue equivalent, which was more than FY24 P&L top line income, which points at our robust cash flow generation. In fact, our way of looking at this working capital cycle is that while we have provisioned this historically and are not affected by this cycle today, this, I believe, in some ways serves as a sort of business mode entry barrier. If someone should endeavor to compete with Park in this segment to these scales, two strong barriers are: one, the business model itself, and second, I think, is this: they will have to provision this working capital upfront on day one.
Interesting. You're using this disadvantage of a longer working capital cycle as a entry barrier for others there. Mr. Gupta, final question to you. Is there a plan to expand your operation to other regions? Because today you are in, if I'm not wrong, Haryana, Delhi, Punjab and Rajasthan. You are not there in UP, which is also a belt which is linked to your, the segment of operation. Or for that matter, Madhya Pradesh.
Yeah. We will be doing aggressive acquisitions as well as greenfield projects in Uttar Pradesh, Madhya Pradesh and Uttarakhand also. We have planned to expand in these states also.
It was a pleasure talking to you today. Thank you very much for joining us today.
And I can summarize the Park Hospital.
Please go ahead.
Thank you so much. Thanks for your time. Thanks for your patience.
So I'd like to summarize by stating that Park Hospital is a very affordable healthcare model for the masses. It caters to around 90% population of India. As well, and apart from it is a noble, it is very profitable. We are delivering handsome patch for the last 21 years. We are very robust healthcare model system. We are we are very unique. We are softly placed at an ARPOB of 28,000, which makes us feel affordable. And also our growth policy is very strong, which will be active for next 15 to 20 years. Thank you.
Thank you very much, sir. Your IPO is opening on December 10th or closes on 12th. 154 to 162 is a price band. Fresh issue of 770 crores and OFS of 150 crores. So the size of the IPO is 920 crores, and that gives you the company a value of nearly 7,000 crores at the upper end of the price band. Thank you for joining us today on IPO Central.